CEO of the Evans Agency in Shurica. My business partner is online with us, Mr. Reginald Thompson. I'll allow him to introduce himself shortly. But I am, as Donald mentioned, I am a second-generation brick mason by trade and still a licensed Florida general contractor. So a lot of the challenges that you guys face in the construction world, I've faced them personally myself. So I want to make sure everyone can hear me. Yes. Okay. All right. So again, Reggie, if you wouldn't mind just introducing yourself.
Yeah, Reggie Thompson. I'm the Chief Operating Officer of the Evans Agency. We are based in Jackson, Mississippi. We have offices in Birmingham, Alabama, Jackson, Mississippi, Quincy, Florida, and Dallas, Texas. We are a Black-owned commercial insurance agency. We are partnered with the 24th largest privately held insurance agency in the country, a company by the name of Insurica. But we do a lot of work in this space. We're excited to be partnered with the team with Square Foot and the project for this minority vendor program, because we're very passionate about working with our minority businesses, getting them to capacity and scale, and being able to participate on projects like this one. So Maurice, I'm gonna let you dive into it.
So one of the things, guys, that we always start with, and that is with risk management. Because guys, listen, risk are the potential losses that must be quantified. See, the risk management process is managing the uncertainty of exposures and risks that impact and affect your organization. Guys, I need to tell you this right at the onset, that if you do not manage risk properly, if you do not measure risk properly, it is impossible to properly manage risk. So all risk must be quantified.
So our typical conversation that we have with our clients revolves around the elements of risk management and how to manage risk. So there are three types of risk every business encounters: business, strategic, and hazard risk. For the purpose of this conversation, we're going to talk more about the hazard risk and the particular insurance coverages you got to have for the Elmore project and the other projects going with the ADOC. But there's 5 ways to manage risk. 1, we can prevent, but we cannot prevent all losses. Number 2, we try to have a plan to mitigate, so if something does happen, we reduce the severity of a loss. Number 3, we contractually try to transfer risk to third parties. 4th, we assume risk, and comes in the form of our deductible self-insured retentions. So if we decide, give an example on your auto insurance, all you guys have to have commercial auto. If you've got a $500 deductible on your personal auto insurance, and you change that deductible to, let's say, $5,000, what typically happens to the premium when we change that deductible? Because you guys are on mute, I'm gonna say, if you change it to a $5,000 deductible, we're assuming more risk, so the premium goes down. So one of the techniques in doing risk management is deciding how much an organization or business can assume based off of their financial structure and what's important to them. And lastly is the financing of the risk. Financing is insurance. That's what we call insurance. So what we know as insurance is a risk transfer and a risk finance tool.
So guys, now in what we have is called a hard market, where underwriters are being more strict on underwriting risk. So when they're looking at your risk, they want to know, are you a good risk? Are you handling all of your business, strategic, and hazard risk properly? Have you quantified it? Are you preventing? Are you mitigating? Are you transferring? How much risk are you willing to assume? And then lastly, you can help control the financing of risk, which we know as insurance.
So when we talk about the areas of risk and the areas of hazard coverage, we talk about property insurance, okay? Property comes in a few different forms. Your actual building, the property is the building that you're in. You start talking about the equipment that you have inside that building. So business, personal property. And then we'll talk about auto physical damage, because your vehicle is a property when it comes to insurance. So the physical damage and it getting damaged and not being able to be used is property coverage. On the casualty side, we're going to talk about work comp in this presentation. We talk about the retention of key employees and business continuity planning. And then liability. Most of the requirements for the Alabama Department of Corrections revolve around our liability side, because They are trying to transfer the risk to you all as individual business owners to protect their interests. So we're going to talk about general liability, the auto liability, umbrella coverage or excess coverage, professional liability, pollution, and then cyber is a big one in this world now because everyone is connected to the internet in some way, shape, form, or fashion.
So here are the requirements for insurance requirements for the Elmore project. The workers' compensation, employers' liability, the general liability, automobile liability, excess liability, which we know and we call umbrella, pollution liability, and professional liability. And we'll talk about each one of the coverages at a little length here.
So what we're going to do is we're going to talk about what each one is and then what the requirements for this project is for you guys to have. So when we look at workers' comp, what is workers' comp? Workers' compensation is insurance that provides cash benefits and or medical care for workers who are injured or become ill as a direct result of the job. So if you have an employee and they slip and fall at the job, they are falling off a ladder, whatever the illness or injury is, if it happens as a part of their work duties, then they have the right to go on work comp claim.
Now, I like to start with workers' comp, guys, because workers' comp is one of those areas that you have the greatest amount of control of your premium. Now, regardless of what your NACE code is or what your classification code is, all of you guys, when you start in business, if you have a premium of above $5,000, your experience mod is what is called a 1. You're a 1. You have a 1. Everyone has a 1. Regardless of what business you're in and you started, you're a 1. Your experience modifies your rate.
Including.
Okay, so roofers may all have the same rate. They just say it's $5 per 100. Okay, we're just using some numbers here. Just say roofers have the same rate. But what changes the rate or what modifies the rate is the roofer's experience. So your direct experience modifies the rate. When you manage your losses, when you close out claims, when you return to work quickly, you're properly managing that exposure, that risk. So again, you get rewarded for that by your experience modification rating reducing your rate. It does exactly that. So if I have less than a 1, I have a credit mod, which means my premium is going to be less. If I'm above a 1 because of my loss history, I have what's called a debit mod, and my premium is going to be more based upon my history, my experience, my losses. So if I'm bidding on a project and we're all equal, but I have a credit mod of just say a 0.8, and you have a debit mod of 1.2, then that means I can bid a little lower than you can because I've managed my work comp premium better than you have and my losses better than you have. So I can now be more competitive.
And guys, with you all being in the construction world, there are some categories of clients that will not allow you on a job with over a 1 E mod, or some of you call it an EMR. So if you're in the utility space, you can't get on the job site with a mod over 1. So we actively try to manage that because, again, like Maurice said, you have direct control of that. Our safety measures on a job and off a job, how we get claims handled and people back to work. Those are big things in managing what that mod looks like, thereby managing the premium. So number 1 is required by law. If you have more than 5 employees, you got to have it. If you have more than 5,000 in payroll, you got to have it. It's the exclusive remedy to on-the-job industry injuries and occupational diseases. So if it happens as a part of the requirements of you sending a person to work, then this is the remedy to get them paid so that they have wages that are coming from the carrier while they're on claim instead of coming from you.
Reggie, we just had a question come in. If you wouldn't mind, they want to talk about is it a 12-month or is this running? Let's talk about the stat date, if you wouldn't mind sharing with them that.
So there's what's called a unit stat date. A unit stat date happens 6 months before your renewal date. So it takes 3 years to develop a mod. So if you've never had a mod before, typically, if you're going to have new coverage, then the carrier is going to give you a rating, basically. It takes 3 years to establish enough history so that now when we look at the history of our claims, they can gauge what your EMOD or EMR is going to be. Once you've established a mod, 6 months before your renewal date, they look at your loss history and they calculate what that mod is. So if you haven't managed it well, we may have a 1.4 mod, which means you're going to be paying at least 40% more. If we manage it really good, and let's say we have a 0.75 mod, then we're paying 25% less. Like Maurice said, we're going to have a credit on it. So that's unit stat date happens 6 months before your renewal, and it takes 3 years to establish a mod. Does that answer the question?
I think it did. All right. So your employer's liability, your employer's liability insurance is a coverage that helps pay for the business owner's costs related to a lawsuit resulting from the employee's workplace injury or illness. And guys, listen, we see this a lot, and we're just thinking about the slips and the falls and what immediately happens. But one of our biggest challenges that with litigation is that we're not handling the claims quick enough. So your employee is home, they're injured, they're out of work, you haven't called, no one from your organization has called, and first thing they do, they had 20 different commercials. First, just give me a call, one call, that's all, you know, and now they've lowered it up on you. So this is why employers' practices liability is so important, that you've got the right type of limits, the right type of coverage to make sure that you can fend off those lawsuits. So without employers' liability insurance, you'd have to pay for all the legal costs out of your pocket.
And guys, let's talk about best practices. Let's be honest. When we're talking about smaller organizations, you're the business development guy, you're the project manager, you're the superintendent, you might be the janitor, you're the back office, you're everything. So a best practice is to have a copy of the state statute. So if one of your guys or ladies gets hurt at work, one of your employees, send them that state statute, because they think just because they watch the TV and lawyers say that they can get them paid, it's all statutory, it's all slotted. Again, they'll pay lost time is 66.23% of what they make at work. There's average daily wage that comes into calculation. So what we can do is communicate with that employee early on so that they know that, number one, we care about. So we want to make sure that we're getting them to the right place so that they can get care for their injury and some professional advice. And number two, understand the process so that they're don't get litigious and think that they can get more out of this claim than is really there. Because honestly, that money comes out of their wages when they settle. So they're paying a lawyer for nothing. So we can communicate better to help ward off some of these miscommunications and get them back to work. And typically, employer's liability is going to be a part of your work comp policy. So go ahead.
So for this project, guys, the requirements are $1 million for each accident, $1 million for disease, for as a policy limit, and then $1 million disease for each employee. So those are the requirements, the work comp and employers' practices liability requirements for the Elmore project.
And guys, some of you all may not have it. Don't let it scare you. We're going to use your payroll to determine your premium. I know many of you already have it. You may not have $1 million limit. So those increases are minor. So this is nothing to be scared about. It's a part of everyday business. And if you need some help, we can walk you through some of these things.
So the general liability, what does general liability cover? It protects your business from claims that is caused by bodily injury. You got to remember there's bodily injury, property damage, or personal injury. The cost for the damage, the property damage claims against your business, the medical expenses, if someone gets injured at your company, someone comes in, this is not an employee, but someone is coming into your business, slips, falls, your general liability policy will kick in and cover that cost. administrative costs to handle covered claims, and court costs, judgments, and settlements for covered claims.
And guys, let me say this. So one of the things when we talk about personal injury, we also talk about libel and slander. So if there's a dispute and someone's reputation is involved and they sue you for that particular item, then general liability covers you should a settlement or a judgment not go in your favor. So again, property, medical expenses, administrative costs, and the cost of judgments if you should lose a court battle. That's what GL covers.
So the requirements for this project is $2 million aggregate. Now, it is commonplace, guys, for most of us in the construction industry to have $1 million single or each occurrence, and then a $2 million aggregate. That's pretty common. Products completion aggregate is $2 million, and then we have $50,000 fire damage, $5,000 medical expense for one person. So these are your requirements for this particular project, and these are the coverages and these are the limits in which the contractor already has. So again, in order for that contractor to contractually transfer that risk to you, you must have the minimum limits that contractor has. And for you to protect yourself, if you're subcontracting work to someone else, you need to require them to have the minimal limits that you have as well.
So let's talk about auto liability. What does auto liability cover? It covers the cost of the other's driver's property or bodily injuries if you are found at fault. So if you or one of your employees causes damage to someone else in your vehicle, it covers their property damage, their bodily injury claim. So bodily injury liability protection applies to the medical expenses that the other party, if you are found at fault in an accident. In some circumstances, it could even cover lost wages and legal fees as a part of your liability coverage. And on the property side, again, it's their property damage if you are found liable and causing a damage to their property.
So guys, here's a big one that a lot of us struggle with when we're getting into construction and we're using our personal vehicle. Okay, well, we're using our personal vehicle and now we're coming on to a commercial project and we think we have coverage. And a lot of times we do not have coverage. And so this is a requirement that this contractor is requiring you to have commercial automobile liability coverage. And then we'll talk a little bit about the limits, and I'll give you an example why it's so important for the limits.
You're going to talk about the situation we had, the contractor that lost a really big contract with his daughter.
I got another one. That's one.
Okay. All right. Well, let's talk about the liability, the limits. So for this particular project, we're looking at $1 million combined limits for bodily injury and property. Those are the requirements for Elmore and ADOC.
So let me tell you why the limits are so important, guys. And we have some of our staff members that's online and even on a personal basis, she doesn't like to have less than $500,000 in liability coverage on an auto, even on a personal. Most of us don't carry that, okay? So let me give you a great example of why these limits are so important. We had a client in Florida, actually, that actually operated a private school. This particular client, and the reason why I'm not giving the construction one, I want to give you show you how multiple claims happened here. This particular client operated a private school for 25 plus years. They had a bus stop where they would meet the families, where they drop off in a 15-passenger van, and they would meet the families at that location. Well, things are going fine that day, nice sunny day, no problem. They get to the bus stop, young lady is getting off of the bus and someone hits the van, the 15-passenger van, rear ends that van, brand new vehicle, only had minimum limits, minimum state required limits, brand new vehicle. Young lady was ejected from the van, had over $2 million in surgery. $2 million in surgery. The driver of the van was injured as well. So now you have a workers' comp claim, plus now this person who was at fault with the accident, rear-end them, only had minimum limits. Their limits were exhausted. This young lady had over $2 million in claims. So who did they have to sue? They sued the owners of the private school. They sued the church. They sued their directors and officers. Everyone got sued, and that church, that school was put out of business after 25 years, all behind one claim.
So guys, understand the purpose of this is to not just make you buy more insurance. It's to protect you. These measures are to protect the Department of Corrections, to protect the general contractor, but they're really to protect you and protect your business as well. So let's talk about excess liability. Umbrella coverage is what you're used to seeing and hearing. Excess liability covers claims that exceeds the limits of your primary policy. So we talked about $2 million on the general liability. Well, once those limits are exhausted, like what Maurice just talked about, what if we have a claim and it's $3 million or $4 million? We've only got the first $2 million covered in our general liability claim. So what happens with the rest of it? Well, you're still liable for that. Your business is still liable for that. So if we've got a $3 million claim, we've got to come up with another $1 million, which can really put most businesses out of business. So the purpose of the excess coverage, the umbrella coverage, is to have a layer of liability on top of your basic layer, which is $2 million, and then $1 million on your auto liability, so that it kicks in to cover that claim to protect you and your business. That coverage sits on top of the general liability. It sits on top of the auto liability. It sits on top of the work comp and employer's liability that we've already talked about. And then the excess liability coverage is, again, for those large losses that could be catastrophic to your business and the continued operation of your business.
Just like we explained about that private school, again, it put them out of business because it exceeded all of their policy limits.
So for the purposes of this project, they're requiring a $5 million excess liability or umbrella to go on top of that $2 million of general liability and that $1 million of auto liability and that $1 million of work comp and employer's liability. That's a part of the requirements.
So pollution liability. We see this a lot, guys, with companies that are hauling sludge and stuff like that, also known as environmental insurance. It provides coverage for loss or damages resulting from unexpected releases of pollutants, typically excluded in general liability and property insurance policies. The losses or the damages covered by pollution insurance usually arise in the forms of claims against insurers for bodily injury, property damage, cleanup costs, and business interruption. So here's a great example, guys. What about the train derailment there in Ohio? That is a major pollution claim right there, because what all do they have to do, guys? First, they have to remove all of the pollutants. The soil, the tracks have to be replaced. The soil has to be removed. And they're even talking about now burning the soil up so it dissipates. So again, this can be a costly loss right here. And so you have to be very proactive in your risk management to prevent losses in this category.
So Maurice, it talks about excluded from general liability property. Can you talk about policy exclusions real quick?
Exactly. Yeah. So that's where we have to be careful, guys, because in the insurance world, the big print giveth, but the little print taketh away. And those are generally in your exclusions. And so you want to make sure, guys, that as you're looking at your policies, that there are no exclusions to the coverages that that you're being required to have. And a lot of us miss those exclusions, and it costs us dearly when we have those claims.
So again, for the purposes of this project, it requires a $2 million pollution coverage. All right, professional liability. What is professional liability? It covers you and your company if a mistake in the professional services is given to a customer or client. Typically, we see this in our engineering sectors, our consultants, but this is errors and omissions insurance. That's what it's typically known as. And again, it covers negligence, misrepresentation, inaccurate advice. But sometimes negligence is as simple as one of your staff members missing a checkbox on a form, or putting too many zeros, or whatever the clerical error may be. That's negligence, or it could be misrepresentation, or God forbid, inaccurate advice. But this is what you hear as errors and omissions insurance, but it is required of all participants on this project.
And remember too, that this contractor, this is a design build project. So they have this coverage. They're requiring you to have this coverage as well.
Okay.
And the limit of this coverage is 5 million each and aggregate.
So guys, before we go to this next section, those are the requirements for the insurance. They include work comp, employer's liability, general liability, auto liability, work comp, pollution, and professional. Before we go further, are there any questions concerning the types of coverage that are needed, the amounts that are needed, or anything concerning the insurance itself? Okay. If all hearts and minds are good on insurance, then we're going to get on the part that we really like to talk about. Okay.
Will we get a one-sheeter with this information, the limits of coverage that we need, the requirements?
Yes.
Yes, you will.
All right, thank you.
And then guys, I will tell you, all of you all should have some forms of insurance. You may not have all of these. So you can easily give those requirements to your current agents to talk through what you're going to need if you're going to participate in this job. Most of these things are pretty simple to get. We've been working as a part of the square foot team and this program to get some monoline pollution coverage, because sometimes that's something that everyone's not used to getting. So we do have a couple of carriers that we can work with you on to get that. And then if you've got an agent that's not familiar or not comfortable with some of these things, give us a call. We can help you guys out, and we'd love to do so. So let's talk about the part we really love to talk about. We love to talk about bonding, surety bonding, because surety bonding is one part of a growth strategy. And that's one of the things that we look at for our clients and contractors, because right now it's a great time to be a Black contractor, to be a minority contractor. There's a lot of opportunities there, and bonding is a way to separate yourself from everyone else to grow your business.
I like to say this, and we have a few, and I think we may have one or two of our female contractors that's on the recording as well. But I like to say this, guys, there are so many opportunities, contracting opportunities right now for small, emerging, and minority contractors. The challenges that we have, the barriers for emerging contractors to entry and for growth is one of the things that that Square Foot Consulting is doing right now, is eliminating some of those barriers in these contracting opportunities. We're going to put out in the next few weeks, Square Foot is going to put out opportunities. Is going to be bid on this Elmore project. So these contracting opportunities are available. This has been a barrier for us in the past. We have one of the other barriers that we've had is information and management expertise. Well, we've got some companies that's online with us today that have some expertise, and we need to start learning how to joint venture with some of those larger companies that have developed those expertise. Trained and reliable workforce. We've got to get better with having trained experts in the field. And then capability and capacity. We talk about this extensively in our bonding presentation, but we've got to be real and true to ourselves. Stop asking for $1 million project when you've never completed a $100,000 project. You got to be true to yourself and understand what your capacity is. Performance issues and dispute resolutions. One of the challenges that we've seen with our small and emerging contractors is that when they have performance issues, we have a hard time resolving those disputes, and it ends up being a bond claim. And that's where we need some more expertise to understand that, hey, when we have some performance issues, we've got to communicate those challenges, communicate to the contractor when you're having some problem, so you can quickly resolve those disputes. And then again, bonding has always been an issue, and access to capital has been a challenge, but we've eliminated a lot of those challenges.
And I'm gonna speak to just one of these, Maurice, the trained and reliable workforce. You all are competing for labor with all of the big boys. You know, Cadell's the general contractor, but you've got several big outfits in the state of Alabama. So while you're needing quality labor and skilled workforce at your level, we're competing again with other larger companies as well. So we've got to do a better job of training and developing talent. I will tell you, there are some programs for workforce development that can help subsidize some of the cost of your talent, because they've got to be trained before they're valuable to you. We've actually used them in our business. So there are some internship programs, on-the-job training programs that we need to look at as far as helping you get the resources to staff up properly. So let's talk about barriers to bonding and kind of some of the workarounds that we've seen. A lot of what we've seen is people only bidding work that bonds are not required, so under $50,000. And that's fine if you're getting some work there. But if we're going to grow, especially for the size and scale of this project and the projects that are coming behind it, you got to do bonded work. So staying under $50,000 doesn't move the needle enough for the owner or the general contractor. Bidding under the prime contractor's bond. Some large contractors have subcontractor default programs so that you don't have to get your own bond. They absorb that. Advocating for bond waivers. And we know that at times, people that are advocating for small and emerging and minority business do work, advocate for these bond waivers to go away. However, the bond says something about how we run our business as well. And your ability to bond, again, separates you from others that don't have the ability to bond. You want to speak to that, Maurice?
Yeah, definitely. Because again, for a long period of time, we have not had advocates on our side, on the bonding side. It has been really a very small circle, a very small box that controlled surety bonding. But thankfully, that's one of the reasons why we're so passionate about what we're doing. I was a general contractor myself, primarily a residential contractor, building 50 houses a year when the market crashed back in 2008. I found myself having to get surety bonding. I knew absolutely nothing about it. My agent knew very little about it, but sent me to a bonding agent that basically told me, hey, here's the best I can do, fill out the paperwork, no instructions whatsoever. I had a fairly decent net worth at that time, but all I could get was $500,000 in bonding. And I took 3 contract houses and my bonding capacity was wiped out. So needless to say, guys, there's no time to run away from bonding. We have clients now that are growing tremendously because they have adhered to our advice and did the hard work of getting their books in order. And that will determine how fast you can grow, how much you can, what your capacity is, how much are you capable of actually doing? And then, guys, how well can I keep my books? How much money can I keep in the bank? So here it is, guys. We love to talk about this, bonding versus insurance, because there is a difference. There's a difference between insurance and bonding. Surety bonds are a non-traditional insurance product. Surety bonds are very similar to bank credit. Surety provides assurance, not insurance. The surety provides assurance that the business owner can complete the project and pay their bills. The surety company guarantees, guys, watch this, 100% of the contract amount. So it's a three-way contract between the contractor, the surety, and the obligee, which is the owner.
So guys, we're running out of time and we want to leave enough time for some questions, but there's a few things that we're going to need in the pre-qualification process. Sound financials. Again, your financials tell the story of who you are from a business operations and financial perspective. Committed and competent personnel. They want to know who's on your team, not just you, but who are your key employees? Who are the people that are performing work? Who is going to assure that this job is done on time and under budget? A business plan. They want to know what your outlook is. They want to know what's the next 3 to 5 years look like for your business. And are you planning to grow? Because if you're not planning to grow, most financial institutions are not interested in really interacting with you because they're looking for people that they can invest in and grow, because as you make money, they make money. And then personal and corporate indemnification. And I'll let Maurice talk to you about indemnification, because when we get to indemnifying or making one whole, that gets to be a different process that you may have never had to partake in.
Now, I know we have some female contractors online, but the majority of us are male contractors. But for our male contractors, I need to explain this to you. Let me just take my time with this one. You must sign a personal and corporate indemnification, which means the surety, you're guaranteeing to the surety that you're going to complete that contract at the amount that you said you would do it. If you do not, and the surety hires another contractor to come in and complete that work, then if there is a difference, an amount over the contract amount in which you agreed to do the work, then you are responsible for that difference. Now, let me explain it. Personally and corporately. You are personally indemnifying it as well as corporately, which means if you are married, gentlemen, your wife has to indemnify the company as well. Personal indemnification. If you are married, your spouse has to sign as well. So we can talk about that a little bit further in the bonding piece, but that is a big hang up for a lot of our contractors right now.
And indemnification means to make one whole, and is our job as the surety to make the client whole. Here's some other things we're going to need. Organizational charts of the companies, resumes of key personnel. Again, your business plan, 3 to 5 years of financial statements, both business and corporate. CPA reviewed financials. I'll let Maurice talk about that in a second. Your work in progress report. We want to know where you are, percentage of completion of those projects, and what is in the pipeline. A continuity and contingency plan. Again, when we start talking about larger contracts, especially $1 million, $2 million, if something happens to you as the owner, what is the plan for getting the work completed? Because the company has signed the dotted line to say that they can get the work done, not just the individual. They want to know your subcontractors. Who do you use on a regular basis? What suppliers do you use? And references from to show your character. Bank lines of credit, if you have any, letters of recommendation. Those are part of the requirements that when you're engaging with a new surety relationship, that surety is looking so that they can determine who you are and the quality of your character and your financials.
And so, guys, we'll talk a little bit more about those, the quality of financial statements in our next bonding piece. But generally, you're going to start in-house with a compilation. You'll run your P&L and balance sheet in-house. If some of you use QuickBooks or some other accounting software, you can do that internally. The next level, when you're getting $1 million and above in projects, listen to me clearly, $1 million and above in projects, you're going to need CPA reviewed financials. And then for much larger projects, you'll need CPA audits done. And we'll talk a little bit more about that in our bonding presentation.
All right. So we're going to stop. We've talked about insurance, We've talked a little bit about surety bonding. Are there any questions?
Well, Mr. Taylor, we're going to turn it on back over to you. And if you, we'll hang out for a few. And if we have any other questions.
Okay,
Just
next.
know-
Go ahead, someone has a question.
I have a question on the indemnification. What happens if your wife is not a part of the company?
She
She has
doesn't,
no ownership.
she doesn't have to be a part of the company. You're married, so she's 50% owner of whatever you have.
The company was established before we got married.
You're still married. Hey, let me, hey, brother, I appreciate it. I've seen guys negotiate multi-million-dollar contracts and couldn't get their wives to sign an indemnification agreement.
Marriage is a corporation.
That's right.
What about pricing? The different pricing, like some people pay 1%, 5%, some people pay 3% for bonding. What about that? How does that determine?
Well, that again, that we'll get into that more in our bonding session, but that's generally going to be based upon your past performance, your credit, and then your capacity.
Okay.
So generally, you can figure between 1% to 3% on average, but generally you'll be closer to that 3% when you're first starting off.
Okay. Well, let me do. I do have a question though about the parties with the marriage. So there is no such thing as creating a Chinese wall between you and your spouse or you personally, or is that only for certain size companies? Because
certain size.
Say again.
Of a certain size.
Okay.
Yeah, if you got a certain size, you can do that. But we're talking about small and emerging companies. And I have one right now, man. We just did one in Texas, $40, $50 million company, and the wife still has to indemnify it. So, I mean, it's a partnership.
Yeah. So for all intents and purposes, the companies that are, let's call them lower middle market, and let's call that between 2 million and let's say 50 million. If you have individual owners, you're typically going to have to sign indemnification agreements and personal guarantee. There is a size and scale out there when you get to the hundreds of millions, if not billions in revenue, that changes, and that is going to be determined by the surety requirements. But for all intents and purposes, if we're in that middle market as far as companies, like I said, 2 million or 50 or 100 million and below, you're typically going to have a personal guarantee, and that spouse is going to have to sign off.
Okay. Is there any other questions?
Yeah, I have a question. So is that the same for the woman-owned business that where the wife is the majority owner, but the husband, so same
Yes,
thing?
ma'am. Yes, ma'am. A spouse has to sign.
Okay, thank you.
Is there any other questions? Okay, again, the bonding, the presentation on bonding is scheduled for March 30th, same time. I will send out a notification for that as well. But at the end of the day, one of the things that we're trying to make sure that we do is educate and get as much information as we can to our vendors so they can be armed with this information so they can get opportunities on these projects, right? Elmore project is April, I think mid-April, we have some packages coming out, and then there's going to be a Scamia and then other projects. What we want to make sure that we do is that our contractors in the state of Alabama is prepared for these opportunities so they can take advantage of these opportunities. And so when these project is over, there's been a material change between where you are now versus where you will be in the coming years. What we were trying to do is put together a team of consultants and partners that anything you guys need on the training side, on the insurance side, that we can provide you guys with that. Now, with that in mind, so there's any other training or any other things you guys want information on, business development, accounting, finance, it doesn't matter what it is, send it to us and we'll make sure that we get those type of training to you guys or get you guys access to the training if we cannot provide it. Okay, it's approximately 12:19. Is there any other questions? Comments? Okay, well, I thank everybody for coming out. If you guys, again, we want you guys to attend the upcoming presentation on the 30th, and we will give you guys a copy of this presentation if you request it. If you guys have any issues logging or anything like that, please let me know, and we'll make sure that we guys get that type of thing squared away, because you have to be registered in the portal to qualify. You have to be registered in the portal for us to be able to communicate back and forth with you guys the material and the training things that we provide. However, that does not prevent you from bidding directly to the prime contractor itself, which is Cadell. You can still do that without being registered in the portal. But in order to take advantage of some of the opportunities and the things that we're providing and services we're providing, you have to register in the portal so we can be able to track all the things and services that we're providing to you guys, right? And make sure we're satisfying your needs as it relates to what you need to be able to compete on this particular project and other projects coming up. Okay, Reggie, Maurice, thank you guys so much, and we look forward to seeing you guys again on March 30th.
All right, you guys have a great day. Y'all take care.
Definitely, it's a pleasure.